The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everyone. This is Bobby Rains here for our once every 3 weeks Investors Observer members only workshop. Broadcasting live from my kitchen today. I assume many of you are maybe not in your usual locations, so hopefully this will go well. As always, we're recording this session, so if there's anything you missed or you want to catch it again, we will be sending out that recording probably tomorrow morning, and so you can catch it and it'll be posted on the website then. All right, let's get started. So our agenda is pretty familiar to those of you who have come to one of these before. We'll talk about what's going on at Investors Observer, our market update, and then we got a lot of questions this time. So thank you to everyone who submitted a question, and then anybody who has a question either now or at some point during the presentation, by all means, don't hesitate to put them in the box, and we will get to them as we go. Let's see here. So what's going on at Investors Observer is we are all working remotely, but we're all still doing all the things we had been doing before. One of the nice things about being an online business is you can do that. It doesn't matter a whole lot where you are exactly. You can still reach us by phone. Help button on the website still works. We're still publishing all the same things, and we're working on some exciting new things that we hope to be able to share with you in the future. All right, so let's talk about the market. So I don't remember exactly where we were 3 weeks ago. I probably could have counted candlesticks. But I had in my notes from a couple weeks ago that I mentioned that the Christmas Eve 2018 low was probably going to be in play. Turns out we tested that, spent a day or two below it on the S&P 500, and then came back. And yeah, usually this chart is 1 year, but I made it 2 years this time because I wanted to get that Christmas Eve low in there, but also just to show both the scale and the speed of the decline here. It's pretty incredible. All right, here's 1 year of daily candles, just so they're not quite so mashed together. See, again, we've had just big candles, big gaps. This has just been it's just been nuts for the last couple weeks, and even on the upslope here, I checked yesterday in response to a question from a subscriber, and the VIX is still, well, as of yesterday, it was roughly where it peaked in 2008 after this rally. Granted, the VIX doesn't necessarily go down when the market goes up. It's not, reverse correlated to the market in that sense. But yeah, the speed and scope of the decline here, and just the absolute technical mess that it left here in terms of looking at the chart is really something to behold. All right, and then 6 months of daily candles, and this is right. The envelope here is Bollinger Bands at 20 and 2, which is essentially takes the last 20 days and finds the standard deviation of the return for those days, and so that envelope is 2 standard deviations away. And the center line is the 20-day moving average functionally. As you can see, we dropped out of the Bollinger Bands a bunch of times on the way down, and then this rally turned around right at the 20-day moving average, which is not altogether surprising from a technical standpoint. I know there's some changes in the sort of outlook and expectations for things as well. So it's hard to say. The line bumped into the other line, and that's why it turned around. But that does, excuse me, that is a thing that you might have expected from a technical perspective, is to see this reverse right here. All right. So what else is going on? Really, sort of, no one knows anything. Right? No one still knows how hard this is going to hit. Certainly, the forecasts have changed quite a bit over the last couple of weeks. The scale of the economic disruption remains a mystery. A couple of weeks ago, we were talking almost exclusively about supply shocks. Now we're at supply shocks and demand shocks pretty severely. The Fed has done a pretty impressive job of inventing acronyms. They have a 3 or 4 letter acronym for all sorts of different facilities, and they're providing liquidity to everyone. Banks, foreign banks, swap lines to foreign central banks, buying assets and doing reverse repo for all kinds of things, doing some other, some direct kind of lending, things like that, trying to keep the the financial system from freezing up. A big difference here from 2008 is this isn't, well, it didn't start as a financial crisis, right? And so what the Fed is able to do is really step in and just sort of spray money everywhere and try to keep it from becoming a financial crisis. And they've done, it seems like, a pretty good job on that front. There was some stuff that got pretty weird 2 weeks ago and a little bit the week before that in terms of some stuff in the treasury market and some money market funds and things like that. But no money market funds, no significant ones that I'm aware of, blew up. Some prices got real weird there for a while, but it wasn't. Sorry, hang on just a second here. It wasn't entirely. It was ugly, but it wasn't an actual market failure like we saw with some things in 2008. And another thing that's important to remember here, moving on to this next point, is the economic data is, as fast as the situation is developing, it's sort of outdated before it gets to us. Unemployment claims, the every week on Thursday number, is probably the one on the shortest lag, right? Because it's roughly 1 week behind, but still 1 week behind. That big number we got Thursday, that 3 million unemployment claims, was actually from the week before. And so what happened last week, we won't find out until tomorrow. And then the big economic report this week is Friday's monthly employment situation report. That's where you get, the number of jobs the economy created, or in this case, probably the economy lost in the prior month. That report, that's also the report where you get like the unemployment rate and things like that. That report is conducted by survey in the week containing the 12th of the month. So the March survey was conducted before that week with 3 million claims, and definitely before last week where people are saying we could see 4 million claims. So that's may not be entirely accurate in terms of telling us what the real picture is. It'll probably be pretty ugly as far as unemployment reports go, but it may not actually tell the whole story. And then, in the sort of non-coronavirus news, or not 100% coronavirus news, because there has been a lot of demand destruction in the oil market. Oil prices are hitting fresh lows again. One Alberta contract was at less than $5 a barrel this week. That's sort of a weird corner of the market. I don't expect that to be a predictor for anything else, right? Like I don't expect, most oil contracts to hit $5. We'll see what happens. But it did happen for one weird corner of the market. And we are starting to see some floating storage come online. Floating storage, what that means is essentially when you run out of places to store oil on land, you can charter a tanker and fill it up with oil and just sail it around for a while or park it offshore somewhere. And we're starting to see that happen a little bit. I forget, I saw a number this morning about some number of tankers leaving Saudi Arabia were departing with no destination on the manifest, kind of a thing. That's obviously pretty expensive storage because you got to pay a boat and you got to pay a crew. It's not the cheapest way to store oil, but that is that's where we're at right now. Is there's just more oil and people know what to do with it or where to put. That's a great time to fill up your gas tank, but most people just have nowhere to go, and that's really going to hurt the on shale, on sure, especially the shale producers, because WTI at 25, 26, 20 even is way below the break even for almost everybody who's pumping oil onshore in the United States these days. All right, so what do we want to watch for? Right, so unemployment claims, we know there's a 1 week lag in data, but that is probably the shortest window in terms of wait time to get data about what's going on in the economy. And there's also some people may not apply for unemployment immediately. A lot of stuff last week was talking about people were having a hard time getting into unemployment offices, websites were overloaded, things like that. So there may be some lag there, but that is the most up-to-date data we get on a regular basis in terms of getting an idea of what the situation in the economy is. Earnings season's right around the corner. The quarter ended yesterday, so the earnings window opens 15 days from the end of the quarter. So we're gonna start getting earnings reports soon, and it's gonna be bad. We will get some updated information about business conditions. Certainly the last 2-3 weeks of March were in the first quarter, but you usually get some update on current conditions also. A couple of interesting things to watch during earnings season. Bad in terms of showing a decline is absolutely going to happen, right? There's no way January and February were good enough business-wise to show an increase year over year from last year, given how bad we know March was. So what'll be interesting to watch are things like how will the market treat actual reported results against earnings estimates. A lot of the estimates have been revised down, but still, analysts have got to be just shooting in the dark in terms of those estimates. So my guess, given what we've seen in the market recently, is it's not going to be a overly optimistic sort of reaction when things miss, but I really have no way of knowing how to predict that. And then, what kind of guidance are we going to get? How many, like a lot of companies pulled their guidance for the year already. I'm really not sure how many are going to, provide new or updated guidance for the rest of the year. I have no idea how you would do that, quite frankly, given sort of what the conditions are now and it being totally unknown how long those conditions will last. That it's not a problem I would want to try to solve in any case. But that will be an interesting thing to watch for in terms of how that gets handled and what people do. And then on the other side, everybody's trying to look for sort of a bottom. And so the things you're going to have to look for there are, so the doubling rate is a thing that epidemiologists and other people talk about. And that's essentially the rate it takes for cases, new cases or deaths, which the one number is a function of the other there, it turns out, to double. And so the doubling rate, when the rate it takes for cases to double starts to slow down, right, that means that you should be getting close to the peak. And the peak doesn't mean we're past anything. The peak means we're past the worst of it. There's still plenty of bad things to happen, and you can't lift, lockdown orders or, stay in place orders just because you're past the peak, because there's still an awful lot of sick people out wandering around at that point. But that will represent a turning point. So that's definitely something to watch for. And then, I would be frankly pretty surprised if Congress didn't pass more of these spending packages. It looks like we're going to be dealing with the sort of economic shutdown situation for longer than people expected a couple weeks ago. And so I would expect there's going to be more of that if we're going to have any hope of sort of a V or even a U-shaped recession here. I think we're probably going to hear a lot about rent relief. Today's the first of the month, rents are due. An awful lot of people lost their jobs halfway through March. And we know from, data even in good times that most Americans don't have a lot of savings to fall back on, especially ones in the service industry where, those are a lot of people who are losing their jobs and don't get paid leave. So there's a lot of people who are going to be really struggling or maybe not making rent. And I don't know, I can't tell you what Congress is going to do. But there are so many different kinds of landlords in this country. It's very complicated to try to put together a program to help either one of them. Right, you have like giant companies like BlackRock owns an awful lot of real estate and is a huge landlord. They can probably handle missing a couple months rent, or even having to just sort of delay collection of that. Where it gets more difficult is small landlords who own maybe a property or two. Maybe that rent is their only income, and so if their tenants miss payments, now they can't make payments. And then you have a real chain of things here. The easiest thing to do, in terms of trying to figure out where all the gaps form, is probably just to send money to people who need money to pay rent. That's probably the easiest way to do that, but how that ends up working out, I don't know. And then there's also some rent issues on the commercial real estate side as well. You have a lot fewer mom and pop sort of landlords on the commercial real estate side, but there could easily be some issues in commercial real estate as well. All right, so questions from readers. We already have some coming in here now, I think. And then as questions come in, let me look through and see if there's anything about what I just covered before we get to new questions. All right, so Rick wanted to know what form rent relief will take. Again, I don't know, Rick. And most of my thinking is on the residential side. The commercial side, again, there's fewer mom and pops. I think the workouts are easier there. And moratorium on evictions certainly helps, but it doesn't solve any of the sort of financial issues in terms of, if somebody, if you have mortgages to pay and you're paying that with rent, now you're defaulting on mortgages, and then, right, you see a wave of mortgage defaults, and it goes up the chain there. So the easiest thing to do in terms of solving the problem is send money to where money is needed, as opposed to trying to work it out further up the chain. But what Congress does with that problem is, they're not calling me for advice in any case. All right, so let's get to these questions that we had sent in ahead of time, and then I'll circle back and get through the rest of the questions that people have submitted so far. All right, so we got this sort of 5-part question from David, and I broke it up, so we'll go through these one at a time here. He says, while we all know this may soon be one of the best opportunities to buy into the market, how will we know when to enter the market? This is a good question. This is a question that everybody is asking right now, and I don't really know. But here's the answer that I would give you in any case. This is really a question about time horizons, right? Like, market timing is very hard. There's no investor that successfully catches the tops and the bottoms. I've talked to traders, and some of what they're trying to do in any given, whether they're short-term traders or long-term traders, in any given cycle, is try to capture a third of the movement, right? So that means, right, if you think about, something turning and going up and then turning and going down, you're trying to catch a third of the different distance from the top to the bottom, or from the bottom to the top, or a third of the difference from the top to the bottom if you're playing it the other way. That's right. Like, it seems like there's a lot of waste there. But market timing is very hard, and even people who are only trying to catch a third of it lose and go broke a lot of times. So what you really want to do is be prudent about asset allocation. Money you need in the shorter term should put in safer assets than money you don't need for a long time. Investing now isn't really that different from investing a month ago. in terms of, in a matter of years, the market will almost certainly be higher in some number of years than it is today. Possibly it'll be higher in a matter of months. Much shorter than that, it gets very hard to guess. And so money you need in 2 months, maybe you don't put it in stocks. And that goes for all-time highs or 30% drawdown. Right, that's just good investing advice, regardless of market conditions. Now, some of these other questions sort of elaborate on this a little bit. So if you have limited available cash, how do you decide if you should sell other investments to reinvest better or faster in better and faster growing investment instruments? So first of all, this depends on your investing goals and time horizons. It's not really right. I certainly can't give a blanket answer for everybody. And I certainly can't, speak to David's situation in particular. But in general, you should try to have an asset allocation mix that gets rebalanced from time to time, right? Like, so you want some money in stocks, some money in bonds, some money in whatever your other things are. And that rebalancing typically means selling leaders and buying the laggards. Right? If you were talking to me a month ago, probably the stock part of your portfolio had overperformed, and you'd probably want to sell some of that and buy some of the things that had underperformed recently to get essentially the percentages of your portfolio back in balance. Again, what you should do now is not really that different. What's different is what you're selling is probably different, right? Like, you're probably not selling the tech stocks today and buying bonds. You're probably going to be able to get, selling bonds and safer assets to buy the riskier ones. But again, how you decide that asset allocation depends on a lot of things that I don't have visibility in for anybody that we're talking about here today. Yeah, in this market, leaders and laggards are different from where you were a month ago. Should you even think about investing in fixed income instruments given the extremely low rate environment? So the thing about fixed income is it's much less about the return than it is about capital preservation. And fixed income, depending on where you go, is pretty safe, assuming you're holding till maturity. Okay, if you're buying 30-year bonds today and you only are going to hold them for 5 years, you could take a bath. If you buy 5 years today and you want to hold them until maturity, right, like that's probably fine. You'll get whatever that coupon is, and then, especially if we're talking about treasuries pay out at par. So you'll be fine there. But yeah, you can still lose capital in fixed income if you sell early. And yeah, not all fixed income is the same. The low end of the credit spectrum, as always, is looking pretty speculative. And a lot of the investment grade credits could be downgraded. Fitch slashed a bunch of retailers this morning from investment grade to high yield or junk. And what happens with that is usually most fund managers look at some combination of rating agencies. So one set of downgrades won't necessarily cause a lot of disruption. And I don't know how many bond funds are holding a lot of retail debt anyway. But right, what happens if things fall between that investment grade and high yield bracket is now the investment grade funds can't hold those anymore and they have to sell them. And so you get some forced selling of assets, which is always kind of ugly, and you don't really want that. So yeah, but I mean, if you're just trying to preserve your capital, treasuries have some nominal interest rate. You can try to match durations, or if you think interest rates are going to go back up soon, buy them on the short end. All right, so with an uncertain time for the market to recover, should people who are eligible for Social Security have been holding off sign up to increase their future payment amount? Yeah, I can't answer that question. That is a question you're going to have to ask somebody who can speak to your specific financial needs and goals. Yeah, it's certainly not a thing I can give any kind of blanket answer to. And is a life insurance a better investment product than for retirees? It depends on sort of what the goal is, right? I mean, do you want this money later? Is it intended as inheritance? It sounds a little crass, but a life insurance policy can have a pretty high return if you pass away during the term of the policy. I'm not entirely certain that was the intent of the question here. I think probably we were talking about some other sort of life insurance-y products, annuities, things like that. And those should really probably be considered an asset class as part of a portfolio, as opposed to like, should I invest all my money in annuities or all my money in something else, right? Like I would really suggest taking the sort of portfolio approach. We saw in 2008 that, guaranteed annuities aren't actually risk-free. There are things that depends on the term of the product. And even if there is, a guaranteed return, you still have some counterparty risk with the issuer, right? I mean, the company that sells you an annuity, it goes bankrupt, you're kind of out of luck there. So those are all sort of things to consider when you're looking at any financial product, especially those. All right, so that's the end of David's multi-part question. So then we got one from Randy who said, if you're assigned a stock and you sell a call against it, let's say you had an initial strike of 320 and you sold a 320 call. The stock is trading at 330 before the call expires, and you want to close the position. Do you sell the stock at the 320 strike, or would it be at the 330 strike? So I'm assuming that this situation arose from a sold put or bearish vertical. Those are the ways you get assigned a stock. Typically is through a put being assigned. So if the stock is at 330, let's start from basic principles here. If the stock is at 330, you sell the stock at 330. There's no reason to leave $10 on the table there, right? That's how that works. Now, if you have a covered call, which is what you have here, if you have a stock and you sell a call against it, you're going to need to buy back that sold call. Which, if that sold call is $10 in the money, it's going to cost you at least $10, which you're going to want that $10 from the stock. Now, if the sold call is assigned, it'll be sold at the 320 strike. But if you're trying to close the position before expiration, strike prices are irrelevant. You sell the stock at the market price, and then you can sell the option for what you can, you have to buy the option for what you can get for it. So it may not necessarily make sense to do that because you're going to have to pay for some time value when you buy that option back. So you may not necessarily want to do that unless you have some, you wouldn't even have a capital gains issue at that point. So you may not want to do that. You may just want to let it go and have it be assigned and called away on that end. But that would be the reason to do that or the way to do that if you wanted to do that. All right, so how do collars work to protect our position? This question was from Jason. We recently put a collar on a trade we've had on for a while on Micron Technologies. They were going into earnings. And so our previous sold call had expired, and so we sold a new call and bought a put at the same time. And so first of all, a collar combines a covered call with a protective put. So we sell a call, which brings in some money, and then we use some or all of that money we get for selling the call to buy a put. So the sold call offsets the price of the put, which keeps the break even roughly the same. In this case, we actually put it out for a zero credit. I think a few people got filled for a nominal credit, $10 like 10 cents, a nickel here and there. But yeah, the goal wasn't really to try to make money on that order. We did get a good chunk of the price of the put back on that particular trade because we sold it. Now, so the way this works is the put will gain value if the stock falls. And we sold the put relatively close to the stock's current price, so that if the stock falls very far at all, the put will start to gain dollar for dollar with what you're losing in the stock. So you're not really losing anything at that point. So with MU, what we did was we were trying to get past earnings. So we sold a long dated call to make sure we had plenty of room for the stock to rise. It was pretty far out of the money, near our original break even, in fact. And we kept the short put relatively tight, both in terms of price, in terms of not being far away from the stock's current price, because we wanted a pretty solid insurance contract there, and then also in terms of time, because the reason to use this strategy is to hedge against a known risk or potential risk. In this case, it was the earnings date, right? There's a chance when you have a stock, they report earnings, the earnings come in real bad, the stock goes way down. We didn't want to carry that risk, so we bought the put to protect against that. Just buying a put, using a collar all the time doesn't make a ton of sense, because essentially, right, buying that put just creates drag on performance. And at a certain point, yeah, your put will gain $1 for every $1 your stock loses, but you're not actually getting anywhere with that strategy. So it's an insurance and protection kind of thing, and not, depending on how you structure it, you can make it be a strategy that will bring in money, but that wasn't really the goal of what we were doing in this case. All right, so Robert said, where do you see the lithium markets headed in the near term? And also, what is our opinion of the pot stocks? In the short term, commodities demand is going to be depressed. I haven't looked at lithium or the lithium stocks in particular, but all the commodities are getting hurt right now. Unless lithium ends up being the cure for coronavirus, I don't see a big rally anywhere in the commodities market in the short term. And so what you're going to need is factories restarted and the economy to open up before demand for commodities comes back online. And that's going to be a while. And yeah, pot stocks had a boom bust cycle in 2019. As a group, they weren't really performing that well prior to the coronavirus outbreak. I haven't really gamed out the potential impacts there, but generally pot stocks are pretty speculative, right? You're talking about something that's illegal in the United States at the federal level. There are some carve-outs and some other things like that, but most of the companies that are active pot stocks in the U.S. are basically biotechs, which is a super speculative sort of thing to be involved in. And you really need to take each one on a case-by-case basis and figure out what their product is and what the likelihoods of success for it are on that front. All right, so somebody who didn't give their name had a question, which was, I have options that expire in 3 months' time. QQQ, Apple, SPY, and I have a big loss in some of them. Should I sell them or hold on to them? So really it depends in this case on the size of the loss. I'm assuming we're talking about just bought calls in this case. So it depends on the size of the loss, right? At down 50%, you can sell now and still have 50% of your investment, which for people who are trading at or near the money or out of the money calls, a 50% loss, not right. That's not a bad trade outcome for people who trade a lot of long options. It's not great, but it's not the worst outcome that you can get. Now, at down 95%, that's awfully close to down 100%. And so what you have at that point is a very speculative long position. I'm not sure I sell that one. I think if you're down 75, 50%, down 25 or 50%, yeah, right. At 3 months, you start to run into, the theta starts to get a little bit higher in terms of a percentage, in terms of a percentage thing. And yeah, you may not want to hold that because unless you think the rally is coming in the next 3 months, in which case you need the rally to come faster than you're losing time value. But at down 95%, you have a lottery ticket. And I mean, yeah. You've already spent the money, you might as well hold on to the ticket to see how it turns out. So yeah, it really sort of depends on the size of the loss there. And I mean, yeah, how much would you be getting back based on selling, I guess, is really what you have to look at there. All right, other questions. I'm going to go back through the questions that have been submitted here already. And we'll try to knock as many of these out as we can. All right, so Dominic says, what is the outlook for bank yields in the next 6 months to a year? If prices remain as low as they are, the yields are fairly high. That is true. I'm not in. I haven't really studied it super hard, but my guess is those yields will come down. I think we're probably going to see some dividends get cut. I think the financial regulators in the UK actually ordered banks to not pay dividends earlier today, perhaps. Maybe it was yesterday. I don't expect that to happen here, but I do expect there'll be some. I expect banks are going to have to hold on to some capital. I know the Fed's trying to loosen things up, but they're really trying to loosen things up on the lending side. I don't think they're as concerned with the returning capital to shareholder side. And so, I think it's possible we could see some bank dividends get cut. But yeah, I certainly don't know for sure. All right, so Jose asked which sectors are good bets or bad bets. We have an article on our website. Let's see here. We're trying to bump it back up to the top here. Your guide to stock investing during the coronavirus pandemic, where we talked about a whole bunch of sectors and sort of what we think the outlook is. And we'll probably be revisiting that over the next few weeks, or we may just start with a new one, just sort of start fresh as the conditions change. But generally, defensive sectors are good bets, right? I mean, I know toilet paper is flying off the shelves. We're not saying, buy Procter & Gamble because there's a run on toilet paper, but it turns out that, right, those are things that people need. My general sense is that hoarding of things like that isn't because I don't think people are using extra toilet paper right now. I think they're just buying it ahead of time. So a 3-month supply of toilet paper that I buy today just means I'm not buying toilet paper for the next 3 months. I don't think it means that I'm, still buying it at the same rate. I'm just buying more of that. I don't think it's happening. So I don't think that sort of, things flying off the shelves behavior is actually a long-term positive for any of these companies. But those things do tend to have pretty inelastic demand. And so I think that's the kind of thing that you're going to want to look at. All right. So then Jose had another question about preset option screen for the best option plays in this environment. So we don't have a preset option screen for the best plays in this environment, but I would tell you that the stock scoring system that we have, it percentile ranks things. And so what that means is the stocks that are the best in any given market will score higher. So the system is, sort of self-adjusting in that way. And so if you look at in the option screener, you just pick a strategy here and then use the overall score rating. So this is our evaluation of the stock. So the high scoring stocks there should be the stocks that are holding up well. And that's true in any market, right? Like in a high flying market, all-time highs kind of market, like we had a month ago, it was different stocks that were at the high scores than there are now. So that's what I would say as far as finding options or any investment in this environment. George asks, is Bitcoin a safe haven now? George, I would say look at it. It doesn't seem like people are buying it like it's a safe haven. If your thing goes down during a panic, is it a safe haven? My answer is no. I'd be interested to hear the argument otherwise, but I don't really see the case for it to be a safe haven because people sold it in a panic. That doesn't seem like a safe haven to me. So Teef asks, says the Fed is planning to buy a variety of assets, including stocks. When is this likely to happen? I think mostly what they're going to be buying is ETFs. And I don't know the exact details of that program. Certainly couldn't tell you when it's likely to happen, but generally my guess is they're going to be trying to spot sort of distortions and things looking like they're coming unhooked, as opposed to trying to pump up equity asset prices. So I wouldn't, yeah. They may be providing a bid on some level, but I don't know that I would expect it to be super market moving in that regard. All right, so Claudia says, in Canada, we're already seeing local companies significantly reducing annual dividends. Another unknown for even stable companies. Do I have any thoughts on how to strategize for those? I don't. I mean, I'm not surprised by that, right? You know, companies are worried about cash flows coming in, and so yeah, if the best thing to do if you're worried about cash coming in is to stop the flow of cash going out, right? And it turns out that dividend programs are designed to be essentially returning excess profits to customer or to shareholders. And if you're entering an environment where you're not expecting to have excess profits, it absolutely makes sense to cut the dividend. So I'm not shocked by that really at all. I would expect to see more of it. We've already seen a ton of companies cancel their share repurchase programs, and I would expect there are probably going to be some dividends that get cut before too long too. Macys, how about Rick? Sorry, Rick says, how about Macys being delisted? Yeah, mall retail. I mean, you know, Sears. Yeah, I'm old enough. I remember things like Montgomery Ward's. But yeah, Sears. Honestly, don't remember what the status of JCPenney is at this point. But yeah, like this maybe hastens that downfall a little bit, but I'm not shocked to see, you know, Macys get delisted. I think their share price coming when it did maybe hastened it. They may have been able to try to do a reverse split or something to pump the share price up a little bit, but honestly, it's not really shocking to me at all. All right, so Marie says, since the market is so volatile, is it best to pull out my investments and wait for the coronavirus issue is contained, or should I maintain the course even though I am a long-term investor and have already lost a significant portion of my principal already? I mean, as you said, you've already lost a significant portion of your principal already, and you're a long-term investor. Unless you, yeah, I don't really see the course in the, you know, purpose in selling things. Again, like I said earlier, you know, you may want to look at allocations and try to rebalance some things or things like that. But that's, yeah, I mean, sell everything and wait it out. I have a hard time looking at those charts we were looking at earlier of the market and saying like, yes, now is the time to sell. And I also have no idea when I would tell you to what to look for to get back in. So yeah, I generally my advice is to sort of stay the course there, assuming you're following some sort of, you know, relatively disciplined practice already. All right, Jose, for moderate risk on doing covered calls, what percent relationship should you expect for call premium to current stock price? That's an interesting question. It's a good one. I always like these questions. I don't know that that's necessarily how I would think about that, because you can get a very high percent relationship there by finding either right? Very risky stocks that trade at relatively low prices. Yeah, a call on a super risky stock will give you a pretty high percent of the stock price in return. But yeah, but you're holding 100 shares of a very volatile and risky stock, so I don't know that that's a good play. And then you can also, yeah, I mean, if you wanted to sell a 2-year call against something, you could get a pretty good return that way also, or in terms of percentage of the share price back in call premium. Um, but that carries a lot of sort of different risks as well. So I don't know that that's necessarily how I would look at that. Um, what I would tend to look at more is the relationship between something like the annualized return and the downside protection. So annualized return is nice because it sort of standardizes returns for time period, right? Like, a 1 week call, a 1 week covered call might be nice, but, or, a 6 month covered call might have a bigger premium, but in terms of annualized return, it's not going to have as big a, the return will be smaller on an annualized basis than at 1 week. And so look at downside protection and annualized return, and try to pay attention to that relationship. I think it's probably a better thing you should do, in terms of trying to find some downside protection, some amount that you're comfortable with, and that's a percentage I would be interested in. And then also look at annualized return. Yeah, Jose, Bitcoin is the leading cryptocurrency. I don't have a particularly high opinion of any of them. All right, here's an interesting question from Rick. Is it too late to invest in DocuSign and Zoom? But yeah, I've been thinking about this one a little bit recently. Certainly they're hot right now. Um, Kind of as momentum plays, I don't know that it's too late because they're still sort of nominally outperforming the market. But in terms of like, are these things I want to stick in my portfolio for 6 months or a year or 10 years? That really depends on some question about, are those businesses going to emerge from this better than they were before? Certainly a lot more people have heard of Zoom than had heard of it a month ago. But name recognition doesn't equal profitability, especially when you have a lot of users on a free tier of something. I don't know what their plan to monetize those users is. Right now, it seems to be cut the meeting off at 40 minutes and hope people get tired of that and pay. There's also a ton of other options, right? Like Google has a Zoom competitor, Microsoft has Skype, and I think maybe a Teams or some other messaging thing may have a video component also. Yeah, there's a bunch of them. They seem relatively easy to set up. I don't know what Zoom's competitive advantage is other than name recognition at this point. And really the bet there is people decide they prefer video conferences to some other form of meeting and start doing it more. And I have no way to know how to model that. DocuSign is sort of a similar thing. I've used it recently to renew a contract for my home internet service, but that's about the only time it's come up for me personally. It's kind of an interesting idea. It certainly saves me a trip to meeting some person face to face. But again, it really, in terms of are those good long-term bets, it really depends on in what ways does consumer behavior or business behavior change after this is passed. And I don't really know how to answer that. Marty, how do I feel about large and regional banks right now? I mean, I think banks are probably, I don't know what bank earnings are going to do. Like I said earlier, I think dividend cuts are entirely on the table. But yeah, I don't think we're looking at a financial crisis. I think the Fed is doing a pretty good job of stepping in and doing some things there. I mean, there are some questions around rental real estate and commercial real estate. And if this goes on for too long, you're going to look at, you know, if Congress were to say nobody owes rent and nobody owes a mortgage payment for 2 months, Does that constitute a default if your mortgage is part of a mortgage-backed security? I have no idea. I don't think anybody has any idea. And so there's some weird questions there that are definitely sort of edge cases. Like I don't expect Congress to do that necessarily. But there are some things that are not outside the realm of possibility where I don't know what the risks are, and so I'd have a hard time saying like, oh yeah, that's great. Just because I can't really wrap my head around all the things that certainly didn't seem probable and maybe not even possible a month or two ago. That seemed like not outside the realm of possibility at this point. All right, so Eric says, what are the general practices for a long covered call when the underlying stock is well above the strike price? So I'm not sure I remember exactly the references to Starbucks trades. I don't know that I remember offhand necessarily. But yeah, typically, so the way we tend to structure covered calls here is that we're happy with the return in the time. If the stock runs way up and we end up holding a thing to the duration and it's in the money the whole time, that's fine. I was happy with that return anyway. The way I tend to think about these is any day I put money into the market, there is something that is going to outperform whatever decision I made, right? It doesn't mean my decision was the wrong decision. It just means I can't predict the future. And so, yeah, sometimes you put a covered call on and the stock jumps and runs away. And so you don't make as much as you would have if you had just been holding the covered call. But if you were happy with the return, the target return when you put the trade on, you got that return. So coulda, woulda, shouldas, whether it's, oh man, I could have done a different thing with this particular stock, or I could have bought a totally different stock. That feels very samey to me, and I don't really know how to do that. I don't really know how to feel like that's a bad decision necessarily. All right, so Dominic, not sure what the question for his previous question was. He said, do I see gold prices rising in the same time frame? Okay, previous question was 6 months to a year, so I'll assume that. Yeah, I don't know. I'm also not super sold on gold as a safe haven. It's certainly a thing that people buy in a panic for a while. Although if you look at the week where the market really panicked, gold also went down. So I can't really predict gold over 6 months to a year. I think if stocks start to rally, gold could fade a little bit. I think if it looks like the recession is going to go on for longer, I think maybe people start to hold on to gold. But yeah, I don't. Yeah, generally gold is maybe the exception commodity wise, but I mean, yeah, what the bidders for, if you think about who's going to be buying gold, you have investors, but my guess is people aren't out jewelry shopping right now. Industrial uses are probably lower, so that probably removes some potential buyers from the gold market. Yeah, I don't know. It's an interesting question, but yeah, I wouldn't feel comfortable trying to guess the price of my guess is in 6 months a $5 bill will be worth about $5, but past that I have a hard time trying to guess the price of assets that far out. Greta, do I see blue chip companies making a decent comeback by October? No idea. It depends on how long everybody ends up at home. We're here in Virginia. There's a sort of stay home order now through June the 10th, I think. Which I think 2 weeks ago nobody would have thought that was a reasonable thing, and now I think Florida's finally coming around to put orders on. But what we've seen is sort of as states start to get outbreaks, the later you put that order on, the longer it is, the more cases you have, the further it ends up having spread, and so I think that. And yeah, once New York Washington sort of went first here. But I think, in the United States where we have free movement between states, just because things start to be on the decline in Washington, I don't think you can lift that, stay in place order because people are, right? Like people might go to Washington all of a sudden and be like, oh, hey, we could go to Washington and do stuff. I'll spend a weekend in Seattle. So you're going to have to keep those orders on pretty much nationwide, I assume, until all the hot spots start to die down. That's my guess anyway. I could be wrong. This isn't entirely this isn't at all my area of expertise. Let's be honest. But I've been reading a lot. So, but that sort of makes sense to me in any case. Amato says, how far in dates should I go on bear call verticals on ES? I don't know. That's sort of a personal preference thing. There's an argument to be made for keeping them super short. You get a smaller premium, but the outcomes are more predictable over the short term. But again, I mean, if you wanted to go out, you wanted to look at bear call verticals on some 2021s. It's an awful long time to have a vertical spread on, but that may actually be I would honestly feel a little bit better about that. That's not the strategy I would use if I wanted to bet on something 2 years from now, or a year from now. But that's maybe where I would feel more comfortable about trying to guess the prices of assets at that point. Rick says, can companies be relisted? Yes, they can. You basically just have to come in line with whatever the exchange's listing requirements are, which is usually something like share price, daily volume, and being a timely, filer with the SEC in terms of earnings and things like that. So yeah, it's certainly possible you can get relisted. It's not. A lot of times there's a bankruptcy or some other thing that's not super pleasant for shareholders to come through there, but that is kind of how that works. Is you can be relisted. All right, we're getting toward the end of my time here. Let me scan through here. All right, so I need to go ahead and sign off here. So I'm going to do that. What I'm going to do is close the webinar, and then I'll try to answer some of these remaining questions by text. But thank you all for coming. This is a great turnout. Way more questions than I was expecting. Thank you all for coming. Don't be shy. We do these every 3 weeks. You can certainly ask questions. Between workshops, like I said, we're still answering the phone. The help button on the website still works. And then, we'll talk to you again in 3 weeks. So, thank you all for coming. Be safe and good luck in the market.